Welcome to Cascade Compliance's fourth quarter roundtable and our annual recap of the CFA Institute's GIPS Conference, which was held last month in Chicago. The recap is a tradition that's been going on for decades with me and Janice and prior firms, and really intended for those who couldn't make it to the event, or for those of you that could but wanted an opportunity to revisit some of that information. Obviously, I'm Kim Cash, by the way, and joined with my partner, Janice Kitzman. We're not going to be able to cover everything that was discussed at the conference over 2 days, but we're very excited to have kind of sliced and diced and hit the high points. We'll be covering everything from the private fund advisor quarterly statement rule, applying GIPS to OCIO assets, database strategies, outsourcing considerations, and of course, marketing rule insights straight from the regulators that were presenting at the conference and sharing that information with you, as well as covering lots of Q&A. So we are going to start with OCIO assets today. Doesn't apply to as many of you, but I have been saying since the beginning, really, these challenges that OCIO managers have are essentially the exact same challenges that every wealth manager has, because you are managing assets not to a specific strategy, but to the individual objectives, to timelines and risk tolerances of your clients. And that makes creating composites that are meaningful very challenging. So there's nothing new about the OCIO challenges, but what is new for the OCIO market is that this is for pension funds and endowments and foundations, all of whom are looking at performance. They want performance and doing a lot more due diligence. And so the need to have composites that reflect the performance is as important as it is for wealth managers who are also showing performance. But some of the differences, and I guess the one thing you need to take away from this conference is you cannot use this. This does not apply to you if you're a retail wealth manager. This is really intended for the OCIO market. However, what's kind of interesting, and by the way, this guidance is out now and it's open for comment. So if you do manage and have kind of an OCIO relationship with any endowments, foundations, you could apply this guidance, and it might be helpful for you to comment on it, because at the end of the day, what it's solving for is the same things that the wealth managers have to solve for. And so because OCIO managers, a lot of them were just having single account composites, representative accounts. Let's just show the asset class performance. Or, you know what, we've only got 3 or 4 OCIO clients. Let's just put them all in one composite. And that's not meaningful. So basically creating buckets, just like we would advise a wealth manager to do, and really having a bucket. If it's a liability focused strategy, then it's about risk hedging versus growth. And if it's a total return objective, then it's going to be, is it growth or is it risk mitigating? But you're basically just like an equity fixed 60-40 portfolio saying, let's have a composite that's 60-40 and plus or minus a percentage, and then maybe an 80-20-20-80. And then what you have to do for this new guidance statement is really define what assets are you considering growth assets, what assets are you considering liability, and then you have these percentages and you have those disclosures. And of course, just like wealth managers, you have legacy asset issues, but it's a little more complicated for the OCIO providers who are managing illiquid private investments that they're taking on. They take a long time before they can get them in, before it reflects their own investments. So So it's very familiar what it's solving for, but it's very unique. I like the solution, and I hope that all of you that are doing this kind of work take the time to read the guidance and comment on it, and utilize it, so that we can have a lot more comparable investments. Janice, I'm going to turn it over to you now. Let's talk some private fund guidance.
Yeah, thanks, Kim. And also, as we're presenting, if you have questions, please go ahead and put those in the chat. We are looking at that, and we would love to take a step back and answer any questions you might have. This is hopefully going to be informative and collaborative with all of you. So when it comes to the private fund advisor quarterly statement rule, which is a whole mouthful, there was a whole session on this, and they did have some lawyers there always, and really some key points to know. The effective date is March 14th, 2025. So you do have time to get into compliance with this rule, as you do with all SEC new rules. The quarterly statements are going to have to be issued 45 days after quarter end and 90 days after fiscal year end. And I think for some advisors, that's going to be a challenge to meet. And I think we're going to see some services pop up, not necessarily from Cascade. This isn't anything we're planning on getting into, but I'm assuming you'll be able to reach out to some providers to help with this. And then the private fund rule doesn't apply to securitized asset funds or offshore funds, which was interesting. I think it makes sense for those. Offshore funds was the one that I was a little surprised by. And then the quarterly statement contains 4 key components. The fund table, which includes compensation, fees, expenses, offsets, and rebates at the fund level. You have to include a portfolio investment table, which includes compensation at portfolio investment level, the calculations and cross-references, which includes disclosures for expenses, payments, allocations, rebates, waivers, and offsets, and cross-references to the private funds offering documents, and then performance. And performance here is a really broad topic. There are a lot of different performance requirements depending on the liquidity of the private fund that you're managing. And so if you want additional information on that, please reach out, and we can send you to some more detailed information. Just for our purposes here today, we felt like we would rather send someone specific information that they're looking for versus cover all of the statistics, because some of them, if you have an illiquid fund, I think you have to have something like 12 different returns depending on what you're invested in. So it's a lot. So with that, there were a lot of questions and a lot of Q&A. I think there's still some things being figured out. There's also some lawsuits going on. I know that the SEC is being sued by a couple different entities regarding this, but what we've heard from everyone is continue as if this is going to stick, and don't wait for this to be figured out in the courts. So with that, the next session we want to cover today is database strategy. And so there was a really great session about this, and a woman from eVestnet talked a lot about what are your database strategies, and do you have one, and what matters. And if you're going after institutional assets, you're generally going to have some sort of database membership, or uploading your returns somewhere in order to even be seen. And she was talking about, what are they looking for? What are they searching for? And one of the biggest things that gets firms ruled out is incomplete answers. And then also obviously making sure that your answers are not just complete, but if you don't answer something that's required, there's an appropriate explanation for that. And of course that your answers are accurate and you can back them up. Review and update the fields annually. I think sometimes that gets missed on database reviews. And, just a plug here, if you're doing that annually, you should also be putting your GIPS reports in there annually as well, and making that some sort of rhythm within the firm. One of the things that was interesting was DE&I was the top parameter for searching. So as institutional managers are looking, or asset owners are looking for managers to invest with, they are sorting by DE&I parameters. And then ESG strategies were also a top search item. So just so you all know, I'm sure most of you do, 4 biggest databases are eVestment, Callan, Wilshire, and Morningstar. If you're not on those databases, I would look into being on those if those fit the strategy that you're going for and the assets that you're looking to get for your firm. The next session that we wanted to cover was outsourcing considerations. This is a question we get asked pretty frequently, particularly when it comes to performance. What are other people doing for performance? Are they outsourcing it? Are they keeping it in-house? What's happening? And so there was a big session on middle and back office functions and where are service providers able to come and help, and what is helpful. Because I think, as we all know, sometimes hiring a third party to do something that is normally in-house, it doesn't always save you time and money. Sometimes you wind up losing some flexibility. And so the ones that I have here are the most common items that are outsourced. And it was interesting. I was sitting at lunch I think this was like right before, I don't remember when the session was, but I think it was right before lunch one day. And I was sitting there and I was talking to a manager, and they were talking about how they outsourced their performance. And I don't recall which provider they outsourced it to, but another manager asked that person, "Do you regret it?" And he said, "Every single day." He thinks about bringing performance back in. And when they asked why, the reason why was lack of flexibility and lack of autonomy. And then the institutional knowledge that happens when you outsource too. So there are pros and cons to everything. And that's really what our takeaway was if you are outsourcing, you're not alone. That's what a lot of the industry is doing. However, you need to carefully consider what you are outsourcing. What are you okay with losing a little bit of control over? And is it what is in line with where the firm is headed? So that was that session. And then, the SEC marketing rule. We're all kind of waiting on pins and needles that, hoping that we're going to get more information and there will be new information. And while there wasn't a lot of new information, I think there was some good confirmation about what, particularly with attribution and hypothetical performance, about what that looks like going forward. What is the SEC looking for? And so when it comes to attribution, it's up to the firms to define if attribution is performance. However, if you deem it performance and it is being used to sell the strategy, then it needs to be net of management fees. So dividend yield came up for fixed income strategies a couple of different times during the talk. And really what the regulator that was there said was, if you're using this to sell your performance, then it needs to be net. And if it's just a component, it could be okay to provide it gross. What I take away from that is probably provide it both gross and net. And how you calculate that, they didn't really give us any information there. But I know that there is more information coming from providers on how to do that. And then sector performance, this continues to be something that people want more information on. And really what it comes down to is it needs to be net of the entire management fee. There have been questions about, well, if you're doing sector performance, can it be an allocation of the fee? Or does it have to be the whole fee? It seems unfair if I take, let's say I have a balanced strategy and I show the equity and fixed income components, can I basically just take a allocation of the fee based on what portion of the portfolio equity is, and then show that performance net of the allocated fee? And they very clearly came out and said, you cannot do that. It needs to be net of the total fee. So that was, I think it was good to have some clarity on that as well. And then hypothetical performance, as I'm sure most of you know, there have been a lot of enforcement action in the last couple of months regarding hypothetical performance. And really, what they have in common is that they were displaying that performance on their website. So they did talk about this. And in addition to that, they didn't have policies and procedures in place. So if you're showing hypothetical performance, don't show it on your website. And then you need to have the appropriate policies and procedures in place in order to make sure that the right individuals are receiving that performance.
I'm just
So
going to jump in here
yeah,
if I can.
go for it, Kim.
Yeah. So I missed the first day of the GIPS conference because I was actually on an SEC panel almost with an identical topic, different SEC examiner, and even brought up the subject of, what if if you have more than one extracted performance, but you're doing it with a system where they're doing sleeve accounting, is that hypothetical? Or is the SEC going to say, in that case, it's okay to have 2 or 3 or multiple accounts extracted if it's through a system and sleeve accounting? And the examiner really came back and said, it's going to be facts and circumstances. And it's going to really depend on your policies. And I would even respectfully take a different position perhaps than Janice if somebody said, maybe yield really is just a characteristic. If you have that in your policies, that this is how we define it, that's going to be a great place to start. And that was really the problem, as Janice said, with all of these firms that got litigation. It was that they didn't have the policies. So what I took away from the examiners, he wouldn't say yes or no, but he definitely said, go to your policies. And you guys, I've had plane delays like crazy today. I'm so sorry. I'm muting my mic again.
Thanks, Kim. Also, Kim, I think you have the next slide. So if you want to do that, you can unmute.
Okay, I will. All right, here we go. It's going to be very high level. Cryptocurrency, they really focused on the DOL litigation that was going on with the For Us All, and they're coming out saying we really have big concerns putting crypto assets in 401k plans, and For Us All is like, oh, we got to get rid of this statement. But it didn't go anywhere because it wasn't a rule. It was just an opinion. It was a position. And so really the session focused on that. It focused on some custody challenges and just all of the problems with regulating right now, legal and regulatory problems with trying to manage crypto assets or considerations for folks that are. So not a whole lot of practical, here's what you can use information. It's just a really challenging area. There was a deep dive into IRR that was so on point for the audience at the GIPS conference, especially if your roles or responsibilities are managing, maintaining even performance in spreadsheets. But even if you just want to know what your performance system is doing with those IRR calculations, or if you're a geek like me who likes to see rules and regulations the way they look in a spreadsheet. So it was a deep dive. It was very helpful clarifying the treatment if you have subscription lines of credit, for example, with and without. So that could be something, if you miss that, that's something where Janice and I could spend time and go over some of that information with anybody in a very one-on-one. But it was very deep dive, followed only by an even deeper dive into some groundbreaking risk-adjusted performance attribution delivered by a professor emeritus. It was definitely 300 level course material, and probably it's not going to become the next characteristic on your slide deck. Risk-adjusted returns are usually separate from attribution. They made a great case for how it could be meaningfully combined correctly. Just don't see any practical use there unless you are really even a bigger geek than me or Janice. There was a leadership soft skill session that was wonderful and really emphasized building relationships, helping people, not being transactional. I think the best part of this session was that it followed the risk adjusted performance attribution session, and we all really needed that. The CFA Institute did a great job letting us know what's going on, what's coming down the pipe. There's even some verification standards coming that Janice is working on as the chair of that subcommittee. But lots of tools have been updated and refreshed, and really just letting people know what's there. Encourage everybody to go to gipsstandards.org and look at the tools and the resources that they have and continue to update. And then the Q&A. And so with that, Janice, I'm going to turn Q&A back to you.
Yeah. So we have just a couple of Q&As that came in as part of the registration process for this webinar. And we wanted to take a few minutes to go over those. And again, if you have any, please put them in the chat and we'll get to those after this. But one of the questions we got was, if you're providing monthly returns, do you need to include the 1, 5, and 10-year in addition to those monthly returns? And really it comes down to who are you providing monthly returns to? If it's a client and it's considered client reporting, then no, you don't need to provide the 1, 5, and 10. However, if this is considered an advertisement, then the required statistics are needed in the presentation. You can't just show monthly. And it really comes down to standardization, right? That's the whole point of an advertisement. It's no longer just a one-off. So that's what we would recommend and what we think. I feel like the SEC has been really clear. 1, 5, and 10 are required or since inception if you don't have 5 or 10 years. And net is all required.
Yeah, and I'll just add that with the private fund rule, that's one of the real complications, is because they don't have the same periodicity. They don't require since inception if you have less than 10 years performance. And so for client reporting, it's a different audience. But then what happens if sometimes you use those client reports as an advertisement? And then would you have to add since inception returns to them? So I'm with Janice. I think the answer is yes. If it's marketing material, just add it always.
Yeah. And then, do you agree that sector returns should be calculated net of fees? And this, again, the SEC was clear. They need to be net of fees. And what we think, I don't think necessarily matters in this, because it really comes down to what have they been clear about at this point, and how do you do it to make sure that you're not putting your firm in a risky place, because you don't want to be one of the firms in the headlines. That's the hope. And so, while we think this could negatively impact firms, I do think the fact that you're all having to do it makes it so that there's a more level playing field, so to speak. And also, firms can still present sector returns gross of fees. They just also have to include net. And I think that's where we're headed, right? And you get to continue to show sector returns gross, but you also have to show it net. So, does it create more statistics in your presentation? Yes, but you still get the benefit of showing gross. And any other questions? I can pause here I see that there's a few in the chat. Kim, do you have anything to add?
No, let's bring on the questions. And if I do have to drop off here,
Okay.
It was great to connect with everybody over the conference.
Yeah. So there was a question about, are the 45 days and 90 days for fund of funds as well? And the answer is no. I believe fund of funds have twice the amount of time because they have to wait for the funds 45 days and 90 days. So they, I believe, have 90 days, and I think it's 90 days and 120 days. I'll have to go look at that, and I can get back to you. The next question is, if a firm calculated the net returns for the first time last year to comply with the marketing rule and used the highest fee in all fee schedules in the past 10 years as the model fee was applied all the way back to inception date, do you see an issue with the SEC marketing rule if marketing presents since inception net returns using this model fee in the materials? I think for SEC marketing rule purposes, there's not an issue here. If you're showing the highest applicable fee for the prospective client now. Where this gets tricky is with fee compression over time in the GIPS standards. So the GIPS standards require, when you're showing the net returns, they need to be the net returns need to be not lower than any client would have received at the time. So this is where it's tricky if you are claiming compliance with the GIPS standards. Is for right now, our recommendation is to go through and look and make sure that the fee that you want to use is not, that model fee is not larger than anything that you've used previously. If you're claiming compliance with the GIPS standards. The other option is, obviously the GIPS standards, it applies to your GIPS report. So you could potentially put other net returns in your pitch book and just disclose them a lot, put a lot of disclosures around those, making sure that a prospective client would know how those are calculated and what each of them is using. But it's definitely a tricky situation as fee compression has happened over time for firms that are claiming compliance with the GIPS standards, and then also obviously having to deal with the SEC marketing rule. Kim, do you want to jump in?
So, and somebody just said, but since inception returns wouldn't be in there. And some firms are adding them because they show their GIPS reports as standalone. Obviously, there's so many different layers to this as you keep peeling things back. But you can also do effective fee tests for that historical performance, and you could have a model fee applied, obviously one model fee historically that is larger, and then more recently the one that's actually applicable now, and that still works.
Yeah, and then is performance and consultant database considered advertising, or is it still in the gray area? This is a great question. It was asked a couple different ways at the conference, and essentially what was said was do your best until they catch up. And Jill from an investment was there and presenting, and she said we're trying to catch up with this and make it so that advisors can put in the information in a compliant way, and to continue to push them to make it so that you can be compliant. But essentially, yes, it's considered advertising. However, there are just limitations that there's not a lot you can do about it other than send off, an email with the required information, or making sure that you're uploading it as well. So that was a big takeaway too. Thanks for bringing that up, Erica. So next question is, what if you show all sectors, which totals to the gross return? So regardless, you still have to show the sector returns net. So you can show them gross, but you can also show them net. You have to show them net. And then if a prospect specifically requested the information, monthly composite since inception returns must you also include the required annualized time periods. I think you have to determine if what you're sending is an advertisement. More than likely, the answer is yes. If it's specifically requested and you have that on paper or email, you probably can get away with just showing the monthly return. But do you want to probably? It's kind of where I land on that. Kim, you unmuted.
Well, I did, because we have a client that struggles with this. They really don't emphasize performance in their advertising at all. And so they get these kind of one-off situations. But the conversation is that what happens when they get a second one? And do they create something completely different to give to them? So it's better just to have a standardized response and presentation. Thank you.
Yeah. And so if you're another question about sector returns is, if our management fee is 1%, does 1% need to be netted from each and every sector return? It depends on what time period in which you're showing the sector return for. So if you're only showing a quarterly sector return, then you'd use 25 basis points. But if you're showing an annual sector return, yes, you would use 1%. So any other questions? And you're happy to, show your face if you'd like, or write more. But for now, the other items that we had to go over in the presentation, it's really just what's next. Where can you find more information? What does this look like? There is a digital package for the conference. I think it's about $500. And it gets you, the conference recordings. Also, if you have specific questions after this presentation, you're more than welcome to reach out to Kim or I. We'd love to answer your questions. Kim and I decided, some of you might have seen, we were going to do an in-person workshop after the GIPS conference, and we wound up having some things happen and had to delay that. So what we actually decided to do, because we've been asked for this, is we're going to do a performance and compliance workshop virtually in March. And this will be more for people with probably 0 to 3 years, maybe 4 years of experience that are new to GIPS, and we want to cover that. Also new to the SEC marketing rules. So if you have people that are on your team that, maybe are changing departments, or somebody that got newly hired, this would be a really great way for them to kind of get their feet wet in knowing what these things are. And so we'll have more information for that probably come the new year in January. And it's not going to be super expensive. So it should be a really good 3 to 4 hours of in-depth information on the GIPS standards and the SEC marketing rule, the performance side of it. And then they announced the 2024 GIPS Standards Conference. It's in San Diego next year in September, which is a big change. They've been in October, and they've heard a lot of complaints about having it at quarter end and everyone being very bogged down by quarter end reporting. So it is back to September, which will be great, and we will be there. With that is all we have for today. So I guess we get to give you a little bit of time back, unless you have more questions.